Hey guys, Koukun here. This video I'm making today is one that's inspired by a comment that was on one of the previous videos I made about the RRSP, the Registered Retirement Savings Plan. And the question went somewhat like this. As a real estate investor who's hoping to build up a portfolio of rental properties that produce income in retirement, for example, if you have a few properties that the mortgages have been paid off, what if my income is higher than it is now? Therefore, any funds I contribute to an RRSP would not get a tax benefit when I withdraw it, because when I withdraw it in retirement, my income may actually be higher than where it's at today. This is actually a very good question, because one of the main benefits of the RRSP is when you contribute, you get a tax refund based on your tax rate today. So for example, if you're in the 50% tax rate today, which is the highest personal income tax rate, and in retirement, if you're say in the 20 to 30% tax rate when you withdraw the funds, then you get that tax savings between the 50 and the 30. However, if you're in the 30% tax rate today, so you get some refund if you contribute, but you're expecting to be in the 50% tax bracket in retirement because you build up a portfolio of rental properties with all the mortgages paid off and there's a significant amount of positive cash flow, then yes, you won't actually get any benefit from withdrawing your RSP in retirement because you'll be actually taxed higher than you are right now. This is where my philosophy around the RSP is a little bit different than what most financial advisors would tell you. I personally look at my RSP more as an emergency fund than a retirement savings, simply because I do have assets in real estate. I have rental property with significant equity. So the goal of my RSP is not necessarily to fund my retirement. I'm fairly more confident that my real estate will fund my retirement, but rather my RSPs are there to support me through any tough years between now and retirement. So if I'm planning on building up my real estate portfolio over the next 20 to 30 years, at some point along the way, there's likely to be some bumps in the road. Every asset class has its, decade when it has a tough time. So real estate, stocks, bonds, private equity, every kind of asset you can think of, there will be a time when it goes through a tough time. And sometimes all assets go through a tough time. That's when we see sort of a market crash and every asset sort of gets hit hard. But there are some times when some assets are hit hard while other assets do well. So that's kind of the benefit of a diversified portfolio. So obviously, as a real estate investor, we are not diversified. We have all our eggs typically in this one basket of rental properties. So as a result, I think it's prudent for my own finances to have some of my investments outside of real estate in an investment that is liquid, right? I can sell it, I can withdraw it at any time if I need it, but at the same time grow at somewhat of a meaningful rate. So in my mind, index funds fit this criteria. So I contribute into my RSP, I take the refund, I contribute that into my TFSA. I have both of these accounts growing for me. And my hope is that if at any point in the future real estate has a tough time, either my personal income is affected, the rental income is affected, whatever the scenario may be, and I can't fully predict it, I want to have some savings in my index funds that I can withdraw if I need it. And yes, if I withdraw from my RSP in those times, I will be taxed. But the idea is if real estate has a hard time and if my personal income is affected as well, then if I withdraw from my RSP, I will be potentially taxed at a lower rate. And even if that's not the case and I am taxed at the full rate, I am only going to withdraw the funds when there's something meaningful that I need those funds for. So for example, if real estate prices crash by 50%, then if I withdraw the money from my RSP and pay the tax hit, I'm still able to invest it into real estate at much lower prices. So my hope is that I make the return based on the profit that I make on the real estate over time. Or in a even worst case scenario, if for whatever reason all my tenants stop paying their rent and I'm at risk of my real estate portfolio defaulting, me not being able to make my mortgage payments, then if I'm withdrawing from my RSP to make those payments, the benefit outweighs the cost. I'm able to keep my portfolio afloat while I deal with whatever issues come so that I can get through that time without being forced to sell any of those properties. And if that situation is happening to me and many other investors, then maybe there's something bigger happening in the economy, something bigger happening in the real estate market. So I always want to have that flexibility of having some funds set aside that I can withdraw and use towards covering any losses or any difficulties that may arise. And this is the tough part. It's There's nothing that I can clearly think of in my mind as situations that I will face, but I know that I don't know everything. I don't see every potential risk. COVID was something that we didn't see before this past year. And even once we saw it, we didn't necessarily see how it was going to impact real estate, how it was going to impact other investments, right? And the results we've seen based on what happened last year completely baffled my mind, right? In the market I operate in the most, Welland, Ontario, that real estate market from beginning to end of 2020 went up 28%. So if you expected that market to crash because of COVID, it did the opposite, going up almost a third, which is, again, mind-blowing even to me. But again, I am a real estate investor. That's going to be my focus. This is what I understand. I'm going to invest into properties that I like in good areas that create positive cash flow. At the same time, I know that I don't know everything. Therefore, it makes sense to have some funds set aside in a liquid investment. And that is the purpose of my RRSP. An interesting strategy with the RRSP that one of my clients has pulled off, and this is something that may apply to you. If you build up a significant amount into your RRSP and you want to invest it into real estate, you cannot directly take the funds out of your RRSP and invest it into real estate. You can only borrow it, and it's not quite advantageous to borrow the funds from your RRSP personally. So one thing that you can do is if you and another real estate investor both have, say, 100,000 in your RRSPs, and you cannot be family members, you have to be non-arm's length, so to speak. So you cannot be the spouse or children of each other, right? Or parents, right? But say you're two friends, you can then lend your RRSPs to each other. You become the borrower of your friend's RRSP, he becomes the borrower of your RRSP, and you can both decide the interest rate of your choice. So many times you can choose as low as 2 or 3% as the interest rate for that RRSP loan to each other, and then you can then invest that into real estate while paying that minimal interest back to each other. And if you have the exact same loan amount, it works out as if you've borrowed from your own RSP and you've invested it into real estate. So it's an idea that's a little bit different from my idea, where I'm keeping my RSP more as a emergency fund. This is more if you want to get that tax refund but still want to invest that into real estate. There are some options there, just it's a little bit complex. You need to have someone in a similar situation to be able to pull that off. A final point about RSPs, this is a little bit different, but if you're in a situation where you're on the other end of the spectrum and you are actually expecting to have a much, much lower income in retirement than you are now, there is a situation where RSPs do not make sense. And this is called the GIS clawback. So the guaranteed income supplement is a benefit that's given by the Canadian government to low-income retirees. Essentially, it allows you to not go into poverty, right? They try to keep you at a minimum of at least $20,000 in income. If you're in a situation where you need to access those funds, it used to be the case that if you made anything above $3,500 a year, you would have a clawback of 50% of the guaranteed income supplement. So essentially, it became almost like a 50% tax bracket. So there are situations where people who are making $20,000, $30,000 a year, where they have saved, put money into their RSP, they've got a very minimal tax refund, probably in the 10 to 20% range. And when they withdraw the funds from the RSP, they're almost essentially being taxed at a 50% tax rate because the funds they take out is reducing the GIS benefit that they would otherwise be entitled for. So if you're in an income bracket of 40,000 or less, many times it's really worth considering to use the TFSA first before considering the RRSP. Currently though, the GIS clawback has been improved so that you can actually make up to $5,000 without the clawback applying. And from 5,000 to 15,000, the clawback is actually at half of that 50%. So essentially you're taxed at 25% up to that $15,000 limit. So it reduces that clawback, that tax rate essentially quite a bit. So it's helped a lot. But definitely if you're in that situation where you're making 40,000 or less, I personally feel you want to first max out your tax-free savings account before looking into the RSP. The reason I'm personally looking into the RSP is that I'm personally in a 43% tax bracket, and I'm planning on staying at that tax bracket moving into the future in order to be able to qualify for purchasing rental properties. So I need to keep my personal income high enough to be able to qualify for mortgages. So as a result, by contributing to RSPs, I'm able to get a pretty significant tax refund. So I hope you found that helpful. If you have any questions, feel free to comment below. But yeah, in summary, the RSP is a great tool as a real estate investor to create a significant emergency fund, a pool of liquid assets that you can access in times of difficulty. So hope you found that helpful. All the best.